So today, continuing along that same roadmap, we'll dive into the double top chart pattern in depth. Chart patterns appear repeatedly in the market, which makes them simple to recognize and explain. This is why most beginner traders quickly become familiar with chart patterns. And it's also the reason large institutional players often trap retail traders using these setups. To steer clear of that, you must grasp the psychology of buyers and sellers that drives the formation of these chart patterns. Only with this understanding can you avoid falling into traps. That's why, in today's video, we'll analyze the psychology behind the double top pattern in detail. Let's begin, but before we proceed, if you find value in this content, hit that like button, and if you're visiting for the first time, make sure to subscribe and enable notifications so you'll always catch our latest uploads. I'll see you right after the intro and disclaimer. This is a 5-minute time frame chart of Nifty 50. After the opening bell, the price stays within a range for some time. Then breaks out of that range and climbs higher. But after facing rejection at upper levels, the price drops a little and then some more. Remaining in this zone for an extended period, it once again attempts to cross its earlier swing high but fails. This results in two nearly equal swing highs on the chart. Since both of these swing highs appear at the top, we call this a double top chart pattern. The buying strength around this level has weakened, which is why the price could not push through this swing high. Let's try to break down why this setup appeared on the chart and the psychology driving it. First, after consolidating in a range, the price broke upward and moved higher. On that breakout, many retail traders entered long trades. Most of them had stop-loss orders in place, but they hadn't been triggered yet. As the market moved a bit higher, some began making profits. Naturally, a portion of these traders booked profits, which caused a slight decline in price. Meanwhile, those who missed the first breakout were eager to jump in when the market again approached this swing high. Because they didn't want to miss out as they did earlier when the price rallied quickly, they placed entries here without waiting for a proper breakout. Long trades began to build up. Traders who entered on this candle placed their stop losses below the swing low. The market then started to decline without crossing the prior high. At this point, that swing low became the last line of defense for buyers, which we refer to as neckline support in the double top pattern. If the market breaks through this neckline, panic can spread in the market. Eventually, once the price slips below the neckline, all the stop losses stacked there are triggered, and the market falls sharply. Buyers who entered at lower levels become nervous as the decline accelerates and start closing their positions, adding to the panic. The price drops quickly without pause. If you want to initiate a short position in such a double top pattern, you can take an aggressive entry right at the neckline breakdown. But for this, the neckline break must occur with a strong bearish candle and a close beneath the neckline. However, it's common that after breaking the neckline, the price retraces upward to retest it from below. If a bearish candlestick rejection forms at this level, you can take a safer short entry there. The double top is an example of trap trading because it gives retail traders the illusion that the market will break past the previous swing high. This leads many new traders, encouraged by the prior strong bullish move, to go long without waiting for breakout confirmation. If the market truly intends to rise, it would need to climb higher and trigger sellers' stop losses above. But there are very few sellers' stop losses at the top, while buyers' stop losses placed below are much larger in number. That's why big institutional players create these false breakouts at upper levels, encouraging retail traders to place stops underneath and open longs. This builds the liquidity required for the market to move lower. This liquidity provides the trigger to take out those retail stop losses. The market then uses that reason to move down sharply, hitting every stop loss at that point. Let's now move on to the next example. This is the 5-minute time frame chart of Bank Nifty. In this case, the market broke out of a range from lower levels and moved upward sharply. After a short pause at higher levels, the price once again attempts to cross the previous swing high but drops before achieving it. This results in a double top formation with a neckline on the chart. Looking at this setup, many of you may feel uncertain because in most videos you've seen about the double top pattern. You were told that identical swing highs are required for the pattern. That's correct, but when you observe live market charts, you'll notice the exact textbook version doesn't usually appear. Therefore, Rather than searching for a flawless pattern, it's essential to understand the reason behind its creation. Shortly after, the price breaks below this neckline support with a strong, large momentum candle. The size of this breakdown candle is very big, and if we were to enter a short trade here, the stop loss would also become quite large. Moreover, such momentum candles are often designed to trap retail traders because once a momentum candle closes, the price frequently reverses, trapping them. That's why we will not take a position at this point. Soon after, the price retraces upward and rejects this neckline, forming a strong bearish elephant candlestick on the chart, which indicates a bearish reversal, which you can check out. At this stage, the price has pulled back and retested the neckline. Hence, we can enter a short trade after the close of this candle, placing the stop loss just above the bearish elephant candlestick. Once the position is taken, the price gradually moves downward and successfully reaches our target. Similarly, if you observe the 5-minute timeframe chart of Bank Nifty, the price rises from lower levels and breaks the day's high. However, because of the absence of strong follow-up buying after this breakout, the price begins to decline, creating a double top formation with a neckline on the chart. After some time, the price breaks below this neckline and drops further with speed. While doing any type of trading, it is not sufficient to only focus on chart patterns in the market and the buyers and sellers connected to those patterns. You must also understand the psychology of sellers. To achieve this, you need to consistently practice chart reading on your own, so you can avoid getting trapped once the chart pattern is in place. That's it, traders. Thank you for watching this video. Don't stop until you're proud. If this video pushed you even 1% forward, smash that like button. And if you're new here, hit subscribe. Your journey starts now. I'll see you in the next video.